Hello?
Hello and welcome to the Hotel Investors Marketplace produced by Hotel Brokers International. I'm Glenda Webb, Managing Director of HBI. The Hotel Investors Marketplace is designed to provide the most current information in franchising, lending, valuation, as well as provide an opportunity to preview recently listed hotels. While we wait for everyone to get signed in and comfortable, we will highlight a few HBI member listings on the screen.
Thank you, Glenda. Hi, this is Charlie Fritsch, President, Hotel Brokers International. I apologize. I was caught in traffic and could not get to my phone and screen. I'll proceed from here. Glenda, okay?
Fine.
Hotel Brokers International is a leading hotel sales organization with more than 50 hotel brokerage specialists. Founded in 1959, the organization's broker professionals have successfully negotiated more than 10,000 hotel real estate transactions and annually account for 48% of all mid-market and economy hotel sales in the U.S. Visit HBI on the web at www.hbihotels.com. If at any time during the webcast you have a question, just click on the Ask a Question button found on the gray bar located at the top of the webcast player. Type in your question and submit it. We'll answer as many as our time allows. Please let us know how we're doing. Rate today's webcast by clicking on Rate, which is found on the gray bar located at the top of the webcast player. Later today, this webcast will be posted to the HBI website at www.hbihotels.com for on-demand viewing. So I'd like to now welcome our speaker, Dennis Nessler, editor, Hotel Business Magazine. Welcome, Dennis.
Thank you, Charlie.
I apologize to you for being a couple minutes late.
Not a problem.
So we have a treat of having your presentation of the annual Hotel Lender Survey, and we appreciate you being on with us and giving us some good information on the latest in hotel lending.
Yeah, no problem. I'm happy to be here and do this. I'm sure most of the listeners are familiar with hotel business. Just to give you a little bit of background for those who aren't, we're a hospitality trade magazine. It's a biweekly publication that comes out actually 21 times a year. Reporting on all the news in the hospitality industry, basically covering brands, management companies, owners, all the different facets of the industry, as well as the brokerage community and many other different companies. But we also have an active website, hotelbusiness.com, where we post news items on a daily basis, and we put out an e-newsletter every day, Monday through Friday, which most of our readers really appreciate and like to get. But so that's a little bit about the publication. We have a circulation of about roughly 40,000 in the U.S., so we're pretty widely distributed and seen throughout the country. So I've been with the publication a little more than 10 years now, and do enjoy covering the hospitality industry and many different parts of it, and particularly some of the deals and some of the things that go on within acquisitions and the lending community specifically, and fortunately there's a little bit more to talk about now in this part of the business than there was a few years ago. So
right, absolutely.
Anyway,
yeah. HBI appreciates our relationship with hotel business, and we have our ad in Hotel Business in every issue, and always get lots of response. And we appreciate the hotel for sale transactions section in the back of the magazine.
Oh, good. Yeah, I should mention too. Yeah, that we do have a relationship with HBI, and we've worked together, recently on a survey that we did for our NYU issue, and look forward to continuing to forward the relationship and working together with HBI and and hotel business together.
Yeah, and we certainly want to continue to further our relationship with hotel business, and appreciate it. And we we're looking forward to some slides. You've got some good info for us.
Yeah. I mean, I guess to start out with, we'll go through some of the various bullet points as we get going. But just in general, my brief overview of kind of where things stand. I mean, from what I'm hearing, and I've been to a number of different conferences and events, from the HELP conference in April in Boston to NYU, to the Alice Summer Update, et cetera. And my general feeling on lending right now and the lending community is that things are loosening up a bit. Loans are a little bit more attainable than they were in the past, but there's still some safeguards in there. There's still some caution with regard to the projects, particularly with new construction projects. There doesn't seem to be a lot happening in terms of the new construction side of things, and that's for a variety of different reasons. But it seems as though the general climate is better for lending than it was, and it continues to get better. I think with each passing month, there doesn't seem to be that big spigot opening that maybe everybody expects, or that big wave of activity. But I think slowly but surely, as lenders continue to clean up their books and clean up their balance sheets, they seem to be more willing to put their toes back in the water a little bit, so to speak, and that's a good thing for the industry. So I think we're moving in the right direction, just probably a little slower than maybe people would like.
Right, absolutely, and we're seeing that as well with HBI and my company, MBA Hotel Brokers. We're seeing more lenders coming back to hotel lending. Not all of them are back yet, but we also do some capital markets advisory with MBA Capital Funding, and we find recently we had a deal, and we had 3 lenders basically kind of competing to get the financing deal for a hotel. And so we're seeing more hotel lending through every program, from SBA 7A, SBA 504, USDA, conventional bank loans, and CMBS. But underwriting remains certainly tighter than it used to be before the crash.
Right, and that's probably a good thing. But that's good to know that there's some competition out there among lenders. I think that's a good thing. One of the things that we'll talk about a little bit is the availability of debt, which is something that I continue to hear out in the marketplace. And there's some quotes from various people in the industry up on the screen there. But the fundamental root of all that, or the fundamental result, I guess, is that should pick transactions up a little bit, that the increased debt availability, and that's something that we've definitely seen more of in the last several months. I would assume you've seen the same, Charlie.
Yes, we have, and in fact, I mean, we're doing one transaction. It's just a simple Quality Inn at about $2.7 million, but the buyer is getting to buy that hotel with only about 12% cash down, and the seller's holding about 5%, and then the balance is an SBA loan. So, of course, to do that, everything's else has to be perfect. The property's got to have great cash flow. The borrower's got to have strong credit, and everything else, and good experience in the industry, which he does. So, but with those things and the government guarantees, loan to values have started to creep up a bit.
Right. The loan to values are what, closer to 70 to 80%, I guess, now, as opposed to maybe 65% years ago. Is that accurate?
Well, depending on the program, yeah. I mean, with SBA, you're typically around 80% loan to value, occasionally a little higher, and sometimes even with SBA lower if the deal has other weaknesses. And with conventional, 70, 75%, maybe 80% if everything's really great and they have a strong relationship with that lender. Of course, CMBS is 65 to 70% LTV generally. Okay,
right. So, just to run through this, increased debt availability will increase transactions, as I talked about. That's a quote from Jeff Davis, and these are all quotes, by the way, that have appeared in the hotel business over the last couple of months in various stories. The next 2 to 3 years should be exciting. There's a tremendous amount of debt that's mature and a lot of opportunity for lenders and providers. From Dan Palmier from USC Funding. In the last 6 months, we've seen a tremendous amount of capital re-enter the debt markets, and we expect this trend to continue for this foreseeable future. From Keith Bauer from Marcus & Millichap. So, just a few, a few little quotes throughout the industry, but just again to underscore the point that debt is definitely coming back and does seem to be available, much more so than it was in the past. We can, if we can move on to the impact of PIPs too. That's one of the things that I've heard a lot as well in the last couple of months, and is that obviously the brands are getting a little bit more aggressive with PIPs. For anybody who doesn't know, that the PIP is a property improvement program that usually takes place when either property changes hands or when there's a conversion from one flag to another, for example. At which time, a lot of times, the brand coming in will insist that the property be brought up to their standards, and things need to be invested and replaced, and obviously expenditures need to be made. But what you're seeing is a lot of potential buyers looking at prices, and while the price of the asset may come in line with what they're looking to spend, realizing that once they acquire that, they're going to have to spend significant money on a PIP is something that they have to factor into the price of the hotel, and in a lot of cases that is negatively affecting their interest and interest level in acquiring something.
Yeah, absolutely, and we're seeing that it's probably the exception that the PIP comes in at what we expected. It's usually coming in a little bit higher than what the seller or even maybe the buyer might have expected. There's still some negotiability depending on the brand. Some brands, there's really little to no negotiation on the PIP, but with other brands, it can be negotiated a bit. And depending on the loan program, PIP costs for renovations can be included, of course, in SBA loans. The money for renovation is added to the total project cost. And then loan to value and buyer's equity is a percentage of that total project cost.
Right.
But it is affecting transactions.
Oh, sure, yeah, and as you mentioned, that it is negotiable and everything, but that's something that like I said, they have to look at when they're thinking about acquiring a property. They have to factor that into the price, obviously, and these PIPs are certainly necessary in a lot of cases because a lot of these assets have been neglected in terms of capital expenditures. But certainly that's something that buyers need to be aware of, and I think it does have the potential to impact things. And just a couple of the quotes, PIPs are reasons why we're not seeing more transactions. That is killing some deals, and rightly so. According to Scott Berman from PwC, the brands have been cooperative about PIPs, but getting a little firmer and drawing a line in the sand. That's from Rob Winchester from Waterford Hotel Group, which is a management company that deals with a lot of the brands and deals with Marriott in a lot of cases specifically. So that's definitely something that we're seeing a pretty big impact on. And if we can move on to the capital requirements for the banks. This is just something that I actually ran across the other day in the newspaper. I thought it was kind of interesting. The Federal Reserve recently announced higher cap requirements for American banks. While the new terms increase a bank's ability to ride out financial trouble, they effectively reduce a bank's ability to make speculative investments and make loans to businesses that want to expand. So it's a little bit of a safeguard. It's probably a good thing for consumers in general, and I think there's a lot of debate back and forth about government regulation and how much is enough and how much there should be. But certainly, in the case of having safeguards and protection for consumers, I think it's probably a good thing. But it does put some handcuffs on some of these banks in terms of what they can do.
Right, and yeah, the bank's capital requirements sometimes comes into play on some hotels, and we're still seeing some distressed hotel sales coming through, and sometimes we've seen some of the banks not they prefer to hold on to it rather than have to sell and take the write-off of the loss right then. So
sure,
it just depends on their capital situation as to how they're acting. And we've also seen in the case where the FDIC is involved and the bank bought a loan portfolio from a failed bank with FDIC guarantees, they're actually more inclined to either make a deal with a discounted payoff for the borrower or, unfortunately, sometimes just foreclose so that they can get the repayment from the FDIC.
Right. And
FDIC covers about 90%.
Oh, is that, yeah, okay. And so, in a time where otherwise, probably a lot of banks would be looking at hotels and the lodging industry as potential to expand their business and expand their capital, invested. They might have to be a little more cautious right now. And again, that's a word that we've heard many times for the last few years is the caution and people kind of sitting tight, which is obviously not moving things kind of the way we want them to. But as everyone knows, everything was such a mess after 2008 and Lehman Brothers and all that. So probably something that's a necessary evil right now.
Yeah, and we've found that even when the capital is available and we have a loan commitment, the underwriting process is more stringent today, and often hotel investors complain about how long it's taking, but it's simply a process of the deeper underwriting today with lenders, and it's hard to get around that unless, I mean, it goes quicker when the borrower is very organized and they've got all their documents ready to go and they can submit whenever there's a question. If not, then that's going to delay things. So anybody that's contemplating a transaction, get all your tax returns and profit and loss statements, balance sheets in order for all the hotels you own so that you can submit them because that'll be a requirement.
Expedite things, right. Charlie, what are some of the things that they are looking a little more closely at from your experience in the last couple of years now that maybe that they would have kind of just rubber stamped before?
The proof of capital, the proof of source of funds, they're very particular about that the buyers show that it's their funds. It's got to be in their account for a certain length of time. They're trying to avoid people borrowing the equity that they're putting in, which could create a greater strain on their operations if they had to pay that back. So that's one thing. For SBA loans, citizenship issues have got to be all documented. Basically somebody needs to be primary borrower needs to be a green card holder or a U.S. citizen. And then the underwriting on the debt service coverage ratio is stricter. And, if it's a CMBS loan, they're going to deduct the FF&E reserve and the management fee from the historical cash flow to come up with the NOI, and then apply that debt service coverage ratio. But even on other loan products, SBA or USDA, the documentation of the debt service coverage ratio is more important today, as well as in some loan programs like USDA, there's a tangible net worth test that has to be met, and they look at that very closely.
Very good. If we can move on to the investor outlook. I'm sorry, strong fundamentals, right? Strong fundamentals. No, that's good. You can go back to strong fundamentals. I skipped one.
There we are.
So that's, again, one of the things that we hear a lot about for the last couple of months is the strong fundamentals, particularly in terms of the supply and demand quotient right now, and that's really at the foundation of everything, and that's really been the case for the last couple of years, which is provided some lift for the industry. Is that the supply is not growing at all, really, very minimally, and demand continues to go up, and that's obviously a good thing for the hotels that are out there. So that is something that the industry has had at its back for the last couple of years. I'm sure supply is going to start ticking up a little bit as we get into the next couple of years, but I think still pretty slow at a slow level. So that's providing, like I said, good performance fundamentals for a lot of things, and it's obviously good fundamentals from a lender's perspective too, with existing assets, because the odds are right now that the properties, if they're in good condition, are going to perform pretty well, and the cash flow is going to be pretty strong. There's a couple of quotes. I'm very excited for the next 12 to 36 months. Fundamentals are strong, and there are a lot of undercapitalized assets right now. Chris Diffley from Rockbridge Capital. Hotel metrics continue to improve, and the fundamentals for continued growth in the industry are strong, from Keith Bauer. So again, that's kind of at the underpinning of a lot of optimism is the strong fundamentals, and has been for a while. It's really a period of these 2 or 3 years now that the industry has seen this, and projects to be the next couple of years as well. So it's kind of a sweet spot for the industry in terms of fundamentals, and hopefully we can capitalize that in terms of lending and additional transactions in the next couple of years as well. Okay, we can move on to Investor Outlook. For the next 2 to 3 years, it looks great. It's a great time to invest. We're in the third inning or fourth inning from Scott Smith from PKFC. And if you can just bring that chart up too. One of the things you hear a lot of talk about innings in the industry, and at the NYU conference it was something you heard a lot about. What inning we're in. Everyone seems to like to speculate on that all the time, whether we're in the second inning, the sixth inning, the seventh inning, whatever. He referenced third or fourth inning. If that's the case, that would obviously be a very good thing for the industry. I don't know if anybody really knows the answer to that, and I don't know why they continue to measure it in a baseball game, but as a baseball fan, I have no problem with that. But anyway, the bottom line is if it is the third or fourth inning, obviously it's kind of in the middle of the game right now, which is, from an investor standpoint, something you want to see, because you don't want to be getting in the seventh or eighth inning when things are about to turn. And this is probably the sweet spot right now from an investor standpoint. If it is the third or fourth inning, to get in. As there should be some good years ahead. In terms of, there's a chart here, which is also from PKF. It measures investment criteria for U.S. hotels, 2012 compared to 2013. One of the things that you'll notice, discounted rate remains a chief concern for investors. The number one really thing that they look at, with roughly 11%. Rating that as their top concern. This year it's down slightly from last year. And then you have cap rates, which come in a little more than 8%.
And these are averages across all chain scales throughout the hotel industry in the U.S.?
Correct.
Is that right?
Exactly.
Yeah. Okay.
Yeah. So then you look at the holding period from roughly 6 years or so, which is about right. Is usually in that 5 to 7 range. There wasn't a whole lot of change from 12 to 13 on that. Debt coverage ratio, again, same, pretty close from 12 to 13. Interest rates, obviously, is one of the ones you see kind of a pretty big change from last year to this, from 6.58 to 5.54. So that's something that's significant.
Positive for the industry and help support values with a lower interest rate on borrowing.
Absolutely right. So I'm sure, yeah. I mean, is that something that you've heard a lot about as well, Charlie?
Well, yeah. I mean, and we've seen, and whether it's CMBS was very attractive rates, and then SBA loans, even the SBA 504 program rates were down as low as like 4.25% and 4.5%. For a brief time, they're ticking up a bit now. And even conventional, we've seen at 5.5%. So It's very attractive rates for borrowing. It's not always fixed. Sometimes they are floating, but there are fixed rates out there as well.
Right, right, and so that's obviously a good thing for borrowers, and that's something that can definitely kill a deal, right? I mean, that higher interest rates can definitely be something that
absolutely. You can support a lot more cash flow at a lower interest rate.
Right, right. So generally positive from the investment standpoint. Generally positive news there. If we can go to asset values. Just a couple quotes. There's a lot of equity chasing fewer deals. That seems to be increasing values somewhat because there's a lack of product out there to buy. That's from Scott Smith. It feels like we're accelerating back to '06 levels faster than I ever thought. From Chris Diffley from Rockbridge. That was a quote that he gave actually during the HELP conference, which I was a little surprised to hear. I don't know what you've seen, but going back to '06 levels obviously was those are pretty high. I think right before '08, we'd be pretty lucky to get back to those levels. So that was something that was a little surprising, but obviously, I don't know if that's something that everybody's seen necessarily across the board, but
yeah,
go ahead.
I think that may apply, and maybe he's speaking more to upper chain scale hotels in bigger metro markets. Yeah. I think in the larger cities, in the smaller markets, secondary and tertiary markets, I don't see it jumping back to those price levels or that much competition to buy hotels. Not yet, anyway.
I see. So high barrier markets, in New York City, those kind of places. I think right.
Yeah, exactly. Exactly.
Yeah. So maybe a little bit of a rosier statement than is actually factual, but or as Charlie mentioned, maybe needs a little more specific drilling down. But generally speaking, the values are going up and are getting closer to where they were. And again, that's something that's a good thing as well. And I mean, Charlie, have you seen the similar? Have you seen the values on the rise as well? Or is it
yes,
market specific?
I think we're seeing people willing to pay we're seeing more regular transactions of cash flowing hotels and people willing to pay higher price per key for those performing hotels.
Mm-hmm. And
there's still distress out there that's selling cheaper, but for the performing hotels with good strong cash flow, particularly with a good brand and in a decent location, then there is more competition. And the first quote on that page from Scott Smith, I agree with. If you have a well-branded hotel offered for sale in a good location and it's cash flowing, then there will be competition for it, chasing after that deal.
Sure. And I mean, are the distressed properties, do they skew the overall numbers quite a bit, or I guess maybe less so than in past years?
Yes, they do skew it some, and and that's where you have to adjust. And even if you look at it by brand, sometimes what's not noted in a sale transaction data is, let's say a Holiday Inn is selling, but there might be a Holiday Inn selling for $120,000 a key, or a Holiday Inn selling for $20,000 a key, and the difference is probably the one selling for $20,000 a key is not going to be Holiday Inn anymore.
Right.
So that revenue is going to drop. It's going to go to a lesser brand, and that's where you see some low price per keys across brand, and that's where you have to dig into that data a little bit more deeply. But yeah, the distress is still coloring the averages, I would say, in terms of values.
Mm-hmm. But the distress is definitely less from a volume standpoint than the last couple of years.
Yeah, I think it's slowing down. Yeah.
Yeah.
Still still a good bit out there, but
right.
And it never really hit all at once or as heavy as people had thought, often at some of the conferences a few years ago, it was like there was going to be a flood of hotels on the market. And I think that was controlled, and the spigot was turned on, so they worked through the system a little more slowly.
Yeah, there was a lot of fear of a lot of blood in the water, and it never really did take place, which is a good thing. I think that having it be a little more gradual, while it may be unfortunately still kind of on everyone's plates, at least it wasn't didn't overwhelm everybody.
Right.
If we can move on to performance projections. Just a couple of numbers. This again was just published in Hotel Business recently. These are as a PKF. STR has really pretty much the same thing. The PKF gets a lot of their data from Smith Travel Research, and everyone knows Smith Travel Research obviously as one of as pretty much the gold standard when it comes to all this. Due to limited supply growth, and we talked about that a little bit before, revenue per available room is forecast to grow between 6 and 7% in most major U.S. lodging markets. And that's for 2013. Given the strong outlook for revenue growth, net operating income is forecast to increase in excess of 10% through 2015, and that's really a significant number too. Obviously, when you're talking about lending, you're talking about cash flow, and net operating income is a very important metric when you're talking about that. So that's good news to increase in excess of 10% if that is indeed the case. And again, these projections are what they are. Obviously, the world changes, and you can never necessarily hold them to the number. But at this point, there's a lot of transparency in the industry, and these guys are closer more often than they're not. So like I said, that's something that's from an investment standpoint a pretty good number to hang your hat on, and for lenders as well to realize that if the net operating income is there, it's a pretty sound investment.
Right. Yeah. And with hotels, net operating income, hotels have fixed expenses and variable expenses. As revenues increase, more hotels will be getting over that break-even point and becoming more profitable. So that's where I can see the NOI projection of increasing in excess of 10% as revenues go up. Dennis, we have a couple questions from our audience. One is on a slide or two before you showed the chart with the discount rate, and we have a question of what do you mean by discount rate 11.05 in 2013 in the chart?
Oh, that was in the investment criteria.
The bar chart that we had.
Right.
And there we go. There it is. So the discount rate.
Right. Okay. So you have the overall cap rate. I would be speculating, Charlie. I don't want to do that, so I can't honestly answer what that refers to. So I can find out if whoever's asking the question wants to follow up with me. I can certainly go to PKF and find out exactly what that refers to, but I don't know exactly what that
right.
is.
Right. It's not something we see very often, but I think it's relative to the underwriting from the lender's side when in the loan application. And actually, we have another question regarding loan application for financing on hotels. The question was, what is the course of action for those who don't qualify for SBA financing because they are non-resident or not a resident of the U.S.? What's the minimum down payment required in this case? I can answer that. Basically,
you would be more qualified to answer that one.
SBA loans, you can go up to 80, even 85% loan to value, or 20 to as little as 15% total equity or cash down payment. Although that equity can be split in some cases with SBA with a seller subordinate note that's in a subordinate position to the SBA. But without SBA loan program, there are lenders, particularly CMBS. If the property qualifies for CMBS, then you'd be at 70% loan to value and a 30% capital injection, 30% of the acquisition price, plus probably additional capital required for whatever PIP and improvements, and maybe some additional requirements for liquidity post-closing. So I'd say without citizen status or green card, and green card is accepted by SBA, then a conventional bank loan or CMBS may be available, and yes, it will require more cash down. Generally 30% would probably do it, depending on, of course, individual issues. They'll still look at the borrower as well as very closely at the property and its cash flow. But yeah, so that's the questions we have right now.
Okay, great. That's probably not a scenario they run into too often, I'm guessing.
Right. No, although we did have a sale last November with a borrower from Canada who, but his son was a U.S. citizen, so basically he put the majority ownership in his son's name, and the lender was then able to do an SBA loan that way. So that's another avenue for a foreign investor, is to have a U.S. partner who, and then you can have a majority interest in the U.S. citizen or green card holder's name. So that's done sometimes. But yeah, usually buyer is U.S. citizen, green card holder, or company.
Right. Okay. So if we move on to the market opportunities.
Yeah, we had gone back to the slide.
A few slides ahead there.
Yeah.
There we go. Just a couple quotes. Dan Nessler from LW Hospitality Advisors. Dan does a quarterly column with the hotel business. Takes a lot of the transactions that have taken place and talks about asset values as well. Scarcity of available hotel product in major downtown markets has forced many players to broaden their geographic scope to include secondary and tertiary markets. Scott Smith says now everyone's looking to second and third markets. So again, some of the high barrier markets are just not really viable alternatives right now to get into, or not at a price that makes a lot of sense.
Well, that's right, and I think that's a factor, and we see that the cap rates are so low in like New York City or Miami, some areas, or certain gateway cities, that people are looking for higher returns and willing to accept, going to a secondary and tertiary market to get that higher return. Right,
and obviously they can get in at a much more reasonable cost per key, and as long as the demand generators are there, it's something that can pencil out for them. But yeah, I think so. That's something that I've also heard from a number of people in the last couple of months, is that they're looking at secondary and tertiary markets. We can go on to transaction activity. This is also from Dan Nessler as well, and the LWHA Q1 2000 Major U.S. Hotel Sales Survey noted there were 26 single asset sale transactions over $10 million that were not part of a portfolio allocation. Transactions totaled roughly $1.9 billion, included roughly 7,400 hotel rooms with an average sale price of $255,000 per key. So, or $255,000. I'm sorry. So just again, just give you a little perspective on the number of deals, which I believe is slightly up from last year. Not a major uptick, but pretty much in line with 2012. So we're seeing a little bit of an uptick, but nothing major. Again, not a flood of activity. I think the portfolio deals are still kind of lagging a little bit. I know there's a lot of sentiment that's going to pick up in a not too distant future. That you might see a lot of big portfolio deals, and I think that's something that we could definitely see in the back half of 2013. Yeah.
We actually have seen more inquiries and discussions from portfolio owners, and I'd say maybe smaller portfolios, from as little as 3 to 6 hotels, or up to 8 to 10 hotels, 15 hotels. People thinking about and exploring values in whether it makes more sense to sell as a portfolio or break it up and sell. Yeah.
Right. And a lot of the people that are looking at that, is that private equity, Charlie? Is that where
Yes.
where do you see a lot of the
Well,
interest?
as far as the sellers, yeah, they're mostly privately held companies.
Right. So yeah, I mean that's something that I think, like I said, I think the industry has been waiting for a while, and I think we've been saying this for probably the better part of a year now, but I do think it is going to start to pick up in the very near future, transaction activity, and that will certainly get things moving, and that will have kind of a domino effect on a lot of different things, because then you're going to have all kinds of PIPs and redesigns and full-out conversions and lots of different things, and obviously it also is going to impact pricing, in terms of the market pricing, and have an effect that way too. If we can move on to the HBI Hotel Business Survey. This is a survey that I referenced that we did. Actually, Hotel Brokers International did this survey for hotel business. I should point that out. We did publish it in our May 21 issue with the sources of funding report, which went to the NYU conference. Roughly 21 respondents. I believe 21 respondents in here. Just gives an idea, and you can just kind of go through these slides of kind of what people are. What they're offering in terms of loans, and whether it's acquisition, conventional bridge, what segments they're looking to lend in, and kind of what the range of the loans is. So just kind of
the number, Dennis, on the right of the bar represents the number of lenders that answered that they're lending in that segment.
Yeah, right. Of the 21, exactly. So for example, when you're talking about luxury, 16 of the 21. Lend in the luxury segment, 15 or 16 in the upscale, 15 in the upscale, et cetera. So that's which means obviously in that case the vast majority looks like lend to pretty much all the segments. Economy maybe being the exception there, and timeshare obviously.
Right.
But just kind of a sense of, and obviously 21 respondents isn't the entire lending community, but it is a good sampling of lenders. So. That's pretty much it for that, and I don't know if we have any other questions. I mean, there's a few other thoughts that I did have on things that aren't on the slides. Just select service. I know and I'm sure Charlie, if you've heard this a lot too. Select service seems to be something that everyone's interested in from an investment standpoint. That lenders are very amenable to these days. That the model seems to work and seems to be very, very popular right now from an investment standpoint. All the brands, obviously all the major brands have invested in it in a big way. So that seems to be right now, if there's one place that people are looking, it seems to be the select serve segment. And obviously lenders always want to have major brands, good reputable brands on things, and they are behind the select service segment too. So. That's something that I've heard a lot about in the last couple of months as well, or really the last year or two actually.
Yeah, select service, of course, being just sort of a in between full service and limited service.
It's the Courtyards of the world. It's the
right Courtyard, Hilton Garden Inn.
Right.
And
the models without major food and beverage offerings, although they do have some offerings. It's not the typical restaurant. It's not all the meeting space, et cetera. Things that have become cost burdens to a lot of operators. And like I said, from an operating standpoint, the select service model really works. And I think you're seeing a lot of lenders looking at those properties as being kind of a sure thing, if you will, as close to a sure thing as you can get these days.
Yeah, I think the franchisors were looking for ways to make food and beverage an amenity they could offer without being a burden of a department that's losing money for a hotel. It can make money if you have sufficient banquet space and do enough catering and banquet business, but when you go a little too small on that, then and you've got a restaurant and a bar that's mostly just catering to the hotel guests, those operations can lose money. And so I think there was a search for ways to have sort of a limited food and beverage offering that would provide the amenity but without a huge cost that the operators have to kick in. And I guess it's also partly that those select service brands are generally with strong franchisors.
That's true. Yeah, absolutely.
And we're seeing that there's definitely a move towards the stronger brands on behalf of investors these days. Hampton, even Holiday Inn Express, Fairfield Inn, Hilton Marriott products, IHG, they seem to be preferred, particularly with very experienced operators. But owner-operators can still have very profitable operations with all the other limited service brands.
But I think from an underwriting standpoint, I don't think a lot of the lenders will look at a project right now unless it has a strong brand behind it.
Right. Yeah, and particularly if it's new construction.
Right. Right.
I think we might have skipped over one slide. Let's look at the range of loans made in 2012.
Okay.
You've got the lenders, the number of lenders there.
Okay. Yeah. So I mean, you got in the 6 to 10 million is 11, and again, that's probably just what we're talking about right now with select service properties. Usually in the 5 to 10 million range, and somewhere in there. So you're probably seeing a lot of activity. Obviously, 11 to 20. So basically, 3 to 20 is kind of where most of the activity is occurring.
Sort of the sweet spot, yeah.
And then as you get 22 to 50 and over 50, you're talking about higher end, luxury kind of products or projects that are a little harder to find, a little harder to come by. But yeah, so that's pretty much it with the loan range, I think.
While we're continuing, I want to ask our viewers to rate today's webcast by clicking on Rate, which is found on the gray bar located at the top of the webcast player. So do that for us, please. And if anybody has any last questions, put those in now, and we'll answer those. Dennis, any other, you had mentioned you might have one or two other thoughts?
I think that was really, just the select services I mentioned. We talked a little about new construction financing. Again, still seems to be a little bit depressed, if you will, for lack of a better word. Doesn't seem to be a lot of it. Again, I think it's going to change a little bit as we move forward, but right now it's still kind of tough sledding in terms of new construction, financing for new construction. We've also, heard a number of things about pent-up demand in terms of loans, and obviously from the last 4 or 5 years there hasn't been a lot. So I think that might be spurring some loan activity as well as kind of the pent-up demand factor.
Yeah, and we're seeing some demand for refinancing, in some cases CMBS, in some cases other types of loans having a term or just for interest rate, the owner wants to refinance. Unfortunately, the SBA 504 program, which was available for refinance for a while, Congress has not yet extended that. It may be extended or reinstated, I should say. However, at the moment, the SBA 504 program cannot be used for refinancing of any kind. It can only be used for acquisition of a hotel. We do have some questions from the audience. First, what kind of rates and who is funding new construction? Did we get any feedback from lenders on rates and anything on, I guess as far as where new construction funding is coming from?
Right. I know that there's some like Access Point, for example, is one company that I know has been getting involved in some of that. There's actually, I just we just did a story the last issue about Shaner Hotel Group is actually forming a REIT now that's going to be funding new construction, which is an interesting kind of little site because they realize that there's a lot of companies out there that are looking to do new build projects and don't have the means to do it right now. So
right.
There's some things cropping up in terms of those guys, but yeah, that's about the ones that I've heard of. I don't, in terms of rates, I haven't really heard too much in terms of specifics as far as that. Maybe you have.
Well, what we're seeing in terms of new construction, yeah, there's not a lot of new construction funding. If the sponsor or the developer is very strong, or partnered with a good management company, and the project demographics, the star report for the market, if all of that is strong, if the brand affiliation is good, and the financial strength of the sponsor or borrower is sufficient, along with a stronger amount of equity, being generally 40% cash down, then there is some new construction financing available. But yeah, there are a lot fewer lenders doing new construction. Some of the local banks, even perhaps some credit unions, and we've seen actually a surge of credit unions getting into commercial lending and for hotels, usually doing SBA loans. And with SBA loans, particularly with the SBA 504 loan program, you could do a project up to like $15 million with an SBA 504 loan structure, even up to as much perhaps as $15 million of debt, with a first mortgage lender doing 10 and the SBA doing $5 million. So because of the increase from $2 million to $5 million with the SBA loan program, we're seeing more people using that, because that government guarantee really encourages lenders, and it's one of the few sources that we've seen out there for new construction.
Exactly. Yeah, they're few and far between these days. Yeah.
Let's see. We also have another question. How can you find potential lenders list for acquisitions?
Well, we do have a list. Again, we have a sources of funding list that we publish, and it was in our recent May 21 issue of Hotel Business. And if anybody wants to contact me, offline or email me, I'll be happy to get them a PDF of that, which lists about any 30 to 40 lenders in the industry right now. And it's not completely inclusive, but it covers a good portion, a good cross section of lenders in the hospitality industry. So I'd be happy to pass that along to anybody.
Great, that would be terrific. So you can contact Dennis Nessler at Hotel Business, and look in the Indeed for that article in the May 21 issue of Hotel Business. Read that article because there's some a little greater depth in there. And do you have those lenders listed in there, or the 21 of them that participated in the article?
Yeah. We have a directory of, I think it's roughly 30 to 40 different lenders in there.
Right.
Including the 21 that were in the survey.
Right. Great. Yeah, I did read the article, but I was a few weeks ago. So great.
All the issues blend together after a while.
Right. Yeah. Well, I want to thank you, Dennis Nessler of Hotel Business Magazine. It's been very informative, and we appreciate your participation with Hotel Brokers International in the National Hotel Lender Survey. Our audience can download a PDF list of today's featured hotel listings from HBI, plus a selection of additional hotel investment assets listed by HBI Brokers under the Attachments button on the top of the webcast player. As a reminder, this and the previous Hotel Investor Marketplace webcasts are available for on-demand viewing online at hbihotels.com, so you can refer your friends to that and they can view it later. We often get 2 or 3 times as many viewers later after the broadcast. Actually, we're still getting questions. I have a question here. What is the max loan limit for SBA 504 loan? 5 million question mark.
The max loan limit? I think it was a little higher than that, was it not?
Well, it is the limit for the SBA 7A program is 5 million. If it's an SBA 504 loan structure, then it's 2 loans, a bank loan in first mortgage position and the SBA loan in second position. The SBA takes those, bundles them up, and sells them off in the secondary market. And the SBA portion is $5 million, and that's in second position. So then it depends on how high of a loan the first mortgage lender is willing to go. We've worked with a number of lenders who are looking for higher dollar first mortgage loans right now, and who will go more than $5 million on the first mortgage, and they can go $8 to $10 million on the first mortgage. And by doing that, you couple it with the $5 million second, so you can get a loan structure of $12 to $15 million in that range as a maximum generally for the SBA loan program. And that's with the SBA 504 loan. It has to go through what's called a CDC, Certified Development Company, which is approved by the SBA to package up and underwrite the SBA 504 loans, and then it goes to the SBA National Office from the CDC to the Sacramento, California National SBA Office, where they review it. And that sometimes, they do have questions, but it usually goes faster than some people think. But the 504 can be a little bit longer than the SBA 7A, but the loan to value and the higher dollar amount that you can get with the SBA 504 loan program is a great advantage, and that's why we see a lot of people making use of that today. So also would like to say that HBI will be exhibiting at the Lodging Conference, and I'm sure Hotel Business will be there.
We will.
Covering the Lodging Conference, being held in Phoenix, September 17th to September 20th. HBI is also a supporter of the Hotel Investment Conference, Europe, being held in London, September 24th to 25th. I was there last year, and that was a great conference. That was interesting. And HBI will also exhibit at the Best Western International Trade Show being held in San Antonio on October 17th to 19th. HBI brokers look forward to seeing you in the next marketplace. So thank you again, Dennis, and thank you, Glenda, for taking care of the intro into this lending survey. I think it was a lot of good information, judging by quite a number of questions. It was strong interest in the information. So thanks, Dennis, for presenting that.
Yeah, it's my pleasure. I hope everyone got as much out of it as I did putting it together, and getting input from you as well, Charlie. And I appreciate your support. And I hope everyone enjoyed it.
Yeah, great. And thank you, Dennis. Everyone, have a great day. We're signing off. Thank you.
Thank you. Bye.
Bye-bye.